Starting with the concept of the derivatives. Derivatives is basically, we understand, is a financial transaction which has been entered upon, and it derives its value based on spot rate of an underlying asset. That is the technical definition of derivative. Derivative is basically, say, a financial transaction that derives its value based on spot rate prevailing for an underlying asset. That is the technical definition that we have. I am giving you, say, a detailed explanation of the same. Understand it carefully. So giving you certain examples with which you will be able to better understand the derivative transactions. For example, let's say there is a company in India called Reliance Limited, and this company has exported goods on 1st of January, for which it is going to receive the consideration on 31st of March. And the consideration is supposed to be received in dollar currency. It is $1,000. Whatever the consideration that it is going to receive, we know that of course it is going to be converted into domestic currency, that is in rupees currency. When you do that conversion, at that point of time, what will be the exchange rate for that? So there is an uncertainty from the Reliance company point of view on 1st of January. So what Reliance company can do? Reliance company can enter into multiple transactions for the purpose of hedging, and one of such transaction is called forward contract. This forward contract is basically an example of the derivative transaction. Suppose a forward contract is entered upon for conversion of the dollar into rupees at the rate of 75 rupees per dollar. Now on 31st of March, let us assume that the spot exchange rate is 77 rupees per dollar. Then in that case, we understand that from Reliance company point of view, the things are not favorable to it. Why? Because it is going to receive 75 rupees only per dollar instead of 77 rupees that it can receive in the spot market. So whatever the less amount that it is receiving is a kind of loss that they have. So this forward contract is resulting into a loss that you will come to know, say, based on the spot rate which is prevailing of dollar currency on 31st of March. So basically the forward contract derives its value based on the spot rate which is prevailing on 31st of March. Now suppose on 31st of March, the spot exchange rate is not 75, but let us say that it is 73 rupees per dollar. Then in that case, entering into the forward contract proves to be beneficial. You are able to receive 75 instead of 73. So entering into the forward contract is beneficial to you. And this is what we understand is derivative transaction. What do we understand with the derivative transaction? It is a financial contract that derives its value based on spot rate which is prevailing for the underlying asset, the date on which the transaction expires. What do we understand with the term underlying asset? In the example that we are discussing right now, in that, so the dollar currency is considered to be an underlying asset. This is what we understand is the derivative transaction. Giving you, say, certain more examples to you, say, to give you explanation of the derivative contract. For example, that say I am a company and I manufacture a product. In manufacturing of the product, say, let us assume that say I require one of the component, let us say that it is of copper. That is say I require to buy copper to manufacture the product. Now there is a, let us say that say there is a tender of municipality in which say I have to fill up a quotation for supplying of this component on monthly basis for a time period of 12 months. I have to supply, say, this product which I manufacture for a time period of 12 months on monthly basis. Now, whenever I am supposed to give the quotation, I need to make sure that I keep the quotation in such a way so that say I am able to make a reasonable margin, and at the same time, say I should not quote say a price say which is going to be loss making to me. Neither I should quote a price say with which it should not happen that I do not receive the quotation. So taking into account the current prices, if at all say submit the quotation, then what happens that say there are fair chances that the price of the copper say may increase, and in that case I will be incurring a loss say in supplying the product later on. It may not be possible for me to store whatever the copper that I will require for the entire 12 months at the current price, and then I will manufacture the product. Practically it may not be possible due to warehouse, so the capacity is limited, or maybe that say I do not have that much funds to buy the product and so on. So what I can do, say if at all I become very conservative, let's say the prices are going to rise, and if at all I submit the quotation, even in that case it is foolishness. Why? Because in that case I will not be receiving say the order. So what I can do, listen carefully, I can just review that what are the forward prices which are prevailing in the market. Whatever the forward prices which are prevailing into that is in the market for copper, taking those prices into account, I can submit the quotation. Once I am awarded with the contract, what I can do, say I will immediately book all those contracts. So what will happen for me, the purchase price of the raw material copper will become constant. There will be a fixed price at which I will be buying the product, and so with that I can have the supply to the municipality. This is the way the derivative contract works. Derivative mainly, not it is only like this, derivative mainly includes three types of contracts. The first one is what I have recently discussed with you is called forward contract. Second and third that you might have heard number of times, it is F&O contract. The term F stands for futures contract and the term O stands for option contract. These three transactions are mainly forming part of the derivative transactions. Apart from that, say we have the number of other transactions also called interest rate cap transaction, second interest rate floor transaction, third interest rate collar agreement, fourth forward rate agreement, fifth swap transaction, and so on. That's there are other transactions also, so which are considered to be the derivative transaction. Initially in our chapter, we are going to have the focus on these transactions, wherein we are going to understand and say what is the forward contract, futures contract, option contract. I don't know, you might have heard something like call option, put option, European option, American option, exercise price, strike price, futures price, all those things that say whatever you have studied means whatever you might have heard about, all those things that say we are going to understand over here. And then we are going to have understanding of the transactions which are called OTC derivative. It is called over the counter derivative transactions. That is what we are going to learn. Recently the institute has also included interest rate futures agreement. That is also the kind of transaction which we are going to have, so the understanding over here. Now one very important aspect that I want to tell you is this, that see the very first thing that I have told you, that there is a company which has imported goods, or there is a company which has exported goods, or there is a company which has taken loan in foreign currency, or maybe any transaction in which say you have entered upon. In that say due to exchange rate fluctuation, there will be say a kind of the risk for you. That is the reason say you can enter into certain derivative transactions in order to mitigate the risk. So this is what say we understand is practically the usefulness of the forward contract. The second thing that say we have understood is that say genuinely when you are doing business, in order to fix the price say at which say you will buy the commodity, so for that also you can enter into these transactions. Again in that say the forward contract, futures contract, option contract are possible. However, the institute has included the examples in our curriculum wherein say they are focusing almost on the stock market only. Stock market is only a part of the derivative concept. However, the institute has included more than 80% examples of the stock market only. That is the reason say we do not have a choice say but to learn the chapter say from that angle more. But as a student you should be having that understanding. So this is not the only thing that say we have. We understand that say suppose that say I'm an Indian company and I have a foreign subsidiary in United States of America, and let us say that say the United States dollar says depreciating. And in that case what will happen at the time of consolidation of my the financial statement, I will have to book a loss. Why? Because the dollar currency depreciates in which I have made investment. So there are certain transactions in which again I can enter upon for the purpose of mitigating the risk. That is called technically the accounting risk and not the financial risk. How to do that? So that is also what we are going to discuss. However, the institute has given less importance to say that kind of portion, and so the more importance is given say to the transactions say which are related to the derivative, in which the stock market is included. Even in the option transaction, whatever the transactions that say they have explained us, in that say there are a number of strategies that say they have explained to us. For example, vertical spread strategy, then strangle strategy, strip strategy, then say butterfly spread strategy. All these are the strategies in which you can enter upon for the purpose of encashing say the expectation that you have say about the price change. In a way that say suppose at this point of time you are expecting that say the market to go down, then what you can do say in the stock market for the purpose of say making gain. If at all you are expecting the market to go up, then what you can do, that is what you can do for the purpose of making gain. Say if at all your expectation fulfills, you are expecting the market to remain stagnant. Even in that case, what you can do for the purpose of making gain, all those things say have been explained to us over here say via say the different strategies, and that is what say we are going to discuss.